let's get the big picture of the financial markets. First off, read this disclaimer carefully. In this video, we will look at Mexico, but let's first get some overview. So here you can see some performance, what's been happening in the market. Looking at sectors, you can see that as far as rallying from the 52-week lows, energy and basic materials are leading. As far as being close to the 52-week highs, tech and healthcare are the kings. If we go here to the zeitgeist, you can see that with a 167% gain from the lows, it is massively outperforming the S&P 500. The biggest movers, definitively, you can see that pandemics, huge move, massively outperforming the S&P 500. You can also see some sizable gains here, nanotech, big move, esports, huge. Holograms, really good. Education 2.0. So there are some very powerful trends out there. In this week's video, big picture video, we will look at Mexico. Mexico will kind of be the backdrop. It's in South America. Here you can see the move from the 52-week low and 52-week highs. Here you can see some data about Mexico. The GDP, Consumer Price Index change, total tax rate, and forested area. Of course, we always read this disclaimer carefully. And here we have the seasonality of the EWW, the iShares MSCI Mexico ETF. Okay, so let's go back into the past first, 1996 to 2015. This is the percentage of months in which EWW closed higher than it opened. We are currently in June, which actually is one of the better months for the ETF, but July and August, especially August, is really bad. That is bearish. If you look at the most recent development, we see the same trend. June, July, August, but then it improves heading into the later part of the year. But this is, of course, good for the bears. Here we have the weekly data points, the chart, looking all the way back to the past. You can see that here you have a very clear bull market. This is strength. Then you get the bear market. But the issue for Mexico is that even though we did have a bull market after the financial housing bubble, we had the high back here in 2013. From this level to where we are today, that's minus 58%. That's a lot of days. I actually did the math. That is 2,695 days. That amounts to over 7 years. Hence, you could make a strong case. You could make a clear case that Mexico has been in a bear market for 7 years. Obviously, that is very bad. That's a problem. Mexico is not some tiny country. This is a very important country in South America. That has been and is currently in a 7-year-old bear market. Something happened after the housing bubble. Not simply to Mexico, but many countries around the world. We are seeing a change in which, back in the day, many companies were participating in growth and development, meaning we had an overall healthy world economy. But after that, we see that there is a decreasing number of companies driving the stock markets. There are a small number of winners that take all the gains. That is not a sign of a healthy world economy. That is a pathological one. So do not be fooled by the S&P 500 and look at this and be like, oh, the world economy is doing fantastic. Look, we broke out way above the housing bubble and things have been doing fine. No, many countries around the world have been in trouble. Here is the United Kingdom. Oh, that's a very different picture. United Kingdom was the previous world empire. The sun never set on the English Empire. Well, the sun has definitively set here. The Russian economy, also pretty important. This is not looking healthy at all. Let's look at Germany. Well, it did not break out above the highs before the housing bubble. This right here looks a lot sicker than this. That's an issue. Let's look at France. Here again, very different behavior. Hence, yes. And let's even look at EVA. That's Australia. Very sick. Very sick. Yes. The world economy is in trouble. If we look here at the moving averages, we see that we tested the 20-week moving average and were rejected. So there is a weakness, and the seasonality was not bullish for the Mexico based on historical performance. The correlation with S&P 500 is minus 28%, so there's a moderate negative correlation. Meaning there could be some very interesting, diversification options here where you could have a trade. You can literally have a trade on Mexico and USA at the same time, and they don't really move together. The correlations, they speak for themselves. Looking at the daily data points, you can see that we are below many of the slower moving ones. The 100-day moving average is a resistance level. We have recently seen some breakdown here. We haven't taken out this level yet. If we take down this level, which would coincide with a breakdown below the 50-day moving average, that would be pretty bad. And given the seasonality, July and August especially August was weak for Mexico, there is a high risk that it will happen. Yeah, definitively something to have your eye on. You can see here on the daily data points that the correlation is different though with the S&P. The correlation here is at 83% positive. So the further back you go when you look at correlations, the more, the more of a bigger picture you get. Because correlations, they can change. Okay. Let's look a bit more at the Mexico ETF. Here you can see the dividend is 4%, that's decent. You can see that we are still, minus 30% year to date. That's not good. If you look here, let's look at some of the dividend data, the PE. So here you can see the PE is 14. That is, decent. But if you want low PE, then it seems here that Argentina is definitively way better if you're looking for that value. Looking for a dividend, if you want a higher dividend than FBZ, well, that's the Brazil ETF. That one has a 15% dividend. That's pretty juicy. Let's look a bit at the holdings. There are some of the companies. Let's look at the breakdown. As far as the sectors, consumer non-cyclicals is pretty big. They are considered to be more safe, so that's sort of, in this current context, that is good, in a sense. Communications, sizable. Basic materials. Real estate and financials are smaller. Yeah. There's the market cap breakdown. Definitively the large caps are dominating. Okay. To sum up my take on Mexico, it is in a 7-year bear market. That's an issue. We do see that there are some clear cycle patterns here, rising and declining cycles. The seasonality does suggest that there could be more pullback on the horizon. I have added some cycle patterns here, rise, decline, rise, decline, rise, decline. Based on these cycle patterns, it does suggest that there could be another attempted rally, but then we do have a declining cycle here, heading towards July here and August, which reaches a bottom here in towards actually into November. You can see here in these previous cycles, like here 1, 2, 3 smaller cycles within, here 1, 2, 3 smaller cycles within, and we could see something similar here as well. Though the overall picture looks, bearish. Okay, that's just how the cookie crumbles. Okay, so let's look at some other markets. Let's look at the bond market. Let's look at the TLT. The interesting thing about the TLT is that we were rounding out here, forming a bit of a rounding top. However, due to the recent weakness in the stock market, we are seeing some flight into the safety of these longer-term treasury bonds, breaking out above these moving averages. So this is looking quite interesting. As you can see here, there is a minus 67% negative correlation between the 20-year treasury bonds and the S&P 500, meaning they do basically move more or less opposite each other. Deterioration in the S&P 500 would be bullish for the TLT, generally speaking. That's something. This is something to take into account if you do see more weakness in the S&P 500. Let's look at the GLD. I was hoping that the GLD would maybe relax a bit more before we try to make a big move, but seems like the bulls are just ready to rally. And if we look here at the correlation, there is a minus 23% correlation with the S&P 500, so there is a negative correlation, but not like very strong. Yeah, I mean, this is obviously bullish for gold. I just would wish that we waited a bit more, simply because we have made a very, strong move, and these resistance levels back here are solid. Like 1, 2, 3 times we failed. We are not that far away from becoming overbought on the weekly RSIs. I mean, I think we can pull it off, smashing through these resistance levels, but it would be easier to do it if we just cool down a little bit more and then make the move. Because now we need some serious catalyst to smash through these levels. And we have already sort of like committed ourselves, so yeah. This is a very ballsy move, but this is what the market decided to do. Yeah, but long term I'm certainly bullish on gold. Though I would wish the strategy had played itself out a bit more cautiously. Let's look at the WIX, the CBO Volatility Index. If you look a bit, let's look at the longer term weekly picture. Let's go way back here. Way back. Okay, so you can see that the WIX is currently here, hence we are very elevated above many previous levels, many different years, which shows us that the market participants are worried about the coming 30 days. The volatility, and that is certainly a sign that there is a very changed sentiment. You could draw a parallel between this spike and the VIX. This one, here you saw a major pullback, then a rally, and then calm. So there are some parallels. The big difference, though, is that this was, a longer-term bear market. It took time for it to develop. What recently happened is that we just completely collapse very quickly, and then have a major recovery in the S&P 500. So basically, this right here is a very condensed time frame. Hence, I actually do not really accept the parallel, because this was normal times, this is just something else. So let's actually look at the S&P 500 so that you can see what I'm talking about. Okay, so it's like this. So the WIX spike we recently saw back here, this was over a longer period. This is a long time. Many months. Well, this, and look here. This complete, like, this is completely different from what happened here. Look how quickly we fell. This is more rational. We take our time, we digest the data a bit up and a bit down. This is a different animal. Look at this recovery. I mean, completely different. Even compared to this is a different animal altogether. And that makes this more dangerous than this. Here, you can be a bull or a bear and have time to act, time to plan. You don't have it here. If you are on the wrong side of the trade, in this kind of a market, you're going to get ravaged. You can get ravaged as a bear here, ravaged as a bull here. And the end result of this, and something that I think will happen, well, at least there's a serious risk of this happening, is that because of this extreme volatility and unpredictability of the market, both bulls and bears are going to get spooked, and they're going to be like, why would I want to have money in something like this? I can't predict it. This is a swing trader's market. But for anyone who has a longer term picture, I have no idea what to do with this. Hence, maybe I should put my money on another market. Maybe I should go into, the forex market, or the bond market, or the commodities, anything else, cryptos, you name it. I mean, this is just too wild. Okay, so let's actually look at Bitcoin. Bitcoin index. Okay, here is the Bitcoin index. The interesting thing here is that we have recently made this rally, trying out these resistance levels. We are pulling back a bit though. So this is a very serious level to tackle. If we break out above it, closing above it, that is, that would be a strong bullish sign. I would make a similar kind of case that I made with gold, is that in order to break out above a very key prior resistance level, you should have a strategy that maximizes your ability to succeed. My issue with this move is that we went up very fast, very quickly, and we didn't have that major catalyst to break out. We hadn't calmed down. So I would have preferred if we went up maybe here, calm down, and then make the move. Instead, we became a bit too eager, and we get into these levels where we struggle and struggle and struggle multiple weeks in a row. The bears notice it, and the bulls, who thought we were going to have an easy breakout, they are starting to become more skittish. They are a bit worried. They look at the previous weeks and they're like, oh, it didn't happen, and then they start to sell. But this isn't like any super bad things happening for Bitcoin yet, but it goes to show you that the most important thing for a breakout is a strategy. You need to make the move at the right time. I do not think this was the right time to do it. By doing it here, there was a higher risk of a fail. That is, yeah. Always have a strategy. Don't be too eager. And I think if you look at Bitcoin here at the seasonality, here Bitcoin to US dollar. So let's look at that. Let's look at the bigger picture. Yeah, this isn't good. June, and we are towards the later days of June. It's currently 7th of June. This is one of the strongest months for Bitcoin. Then it becomes weaker towards August. That doesn't bode well here. Hopefully, if we do get further pullback, we will find support here at preferably the 20-week moving average. Then shuffle a bit sideways, and then we can maybe build energy to break out. You could make the case that we would be building an inverse head and shoulders pattern. Boom, boom, boom. Okay, we are running out of time. Okay, whatever you do, of course, don't fight the trend, and may the trend be with you.